today, the 26th of November already. So, years has fly, and as soon as you notice, we are already on November, and next week is December already, right? So if we look at here on the calendar, we're on the 26th. There's only 4 more days for this month, and then on Sunday we start the new month, December, and then on first Friday, the 6th of December, it's going to be the NFP. So lots of things happening on the market. We had some huge volatilities just today on US dollar CAD. I don't know if you've seen that, but I've posted a video on YouTube channel. So let me just bring it up so everyone can have a look at it. Here, I've posted this video here talking about the Canadian dollar that has been raising after the Trump tariff. So you can see here this huge moves. I'm going to share the link on the chat. So YouTube video. There you go. Just share it now so you can have a look at that. But yeah, look, markets are, very volatile, and December will be a decisive because we're going to have a few monetary policy decisions, Bank of Japan, FOMC, ECB, BOE. So the month of November was very, very slow. We only had RBNZ, if I'm not wrong, or not even RBNZ. I can't remember now. But there's definitely plenty of volatility coming for the month of December. So we're going to be talking about the United States navigating the uncertainty that is happening over there. Trump is saying something, he's not even in power yet, and the market is already reacting strongly. So that's the power of, a man that on his words, whatever he say, the market knows that he will do in the future. So that's really, really interesting how the market is reacting. The Eurozone is on a balancing act. I do believe that the ECB is trying to balance the things out with the strongest US dollar we've seen this year. If we look to euro dollar, more than 600 pips already, 6,000 points, 600 pips moving down, and with no correction. If you believe on that, some people that may be using Martingale as a strategy, they are some way stuck at the moment because Martingale consisting pretty much you're opening a double or 1.6 times bigger lot size in the next order. So let's just say that your order right now is 1 lot. The next order on loss will be 1.6 lots. If it's a 1.6 times multiplier, or maybe it's a 2 multiplier, then it's going to be a 2 lot, right? So, and then from there, 2, 4, 8, 12, and it goes 16, 21, and it goes like that. So there's definitely lots and lots of things happening on the market. Third is the Japan, the stability amid global shifts. Japanese yen is sort of somewhat trying to be stable at, we've seen a lot of volatility from Japan because of the Bank of Japan. And I've talked about that on, when did I talk about that? I think I've talked about that on last Thursday, if I'm not wrong, talking about the Japanese yen and the comments you either have mentioned it. And it's on the YouTube video, as maybe we do have some new people here. That's really good. But for those who don't know yet, every time we have a webinar, we post a replay on the channel, on the YouTube channel. So I'm just getting the video right now for everyone. There we go. That's the one. So global tension and safe haven forex trends navigating year-end volatility. All right. So you can have a look here, talking about the yen. I've sent it up on there. But yeah, I've mentioned it about the Japanese yen, the safe haven currencies, Japanese yen and CHF in focus. You guys can definitely have a look on that as well. And then fourth, I know it's something that not much people talk about, but I think it's a really good topic for us to talk about is the emerging markets. Okay, emerging markets, that's presenting a lot of opportunities in there. and especially on the Eastern Europe. All right, so we're gonna just briefly touch base on that. We're not going to spend much time on that, but there is definitely something that we can always learn from emerging markets. So if if you have talked about emerging markets before, beautiful. If you've not, it's your first time, don't worry. It's a normal economy. We're just going to be talking about something that is not much touch base at before. All right. So still some people joining us. That's pretty good. But as usual, before we go any further, I'm going to just do the disclaimer. And once I do the disclaimer, we can start. All right. So I'm going to be 1 minute muted. Oh, sorry. I forgot to put in a full screen. But here it is, the slide again. So United States, Eurozone, Japan, and emerging markets. Now, read the risk disclaimer. Before we start, I'm going to give a minute to everyone, and then we should start soon. The Federal Reserve is on a, as I like to say, is on a very pivotal juncture, right? So it's one of the most important times. After we had the October rate cut of 25 basis points, and November as well. Sorry, not October, November only, 25 basis points cut. Market sentiment remains somewhat divided on whether another cut will be done in December or not, as we can see right here. Some key data points are still on the horizon, like the GDP revisions, personal spending cut, as well as the core PC deflator. But what does all of this data tell us? Okay, so according to some fonts, to some sources, the core PC is expected to tick up to 2.8% year on year from 2.7%. So 0.1% higher. While this remains within a acceptable limit of a gradual disinflation trajectory, it's pretty much highlighting to me as I can see that it's pretty much highlighting to me that it's the inflation is persistent on the services sector. All right. And this is very concerning for the policymakers from the FOMC, for the FOMC. But what's the difference between this time and before? What's the difference? Well, the Treasury sector, whose measured approach may provide some more stability to us. I've been reading. I think his name is Scott Bessent. Let me just try to search his name. That's the guy. Let me just put it here. Yep, there's a guy. So he's hedge fund manager. He was partner at Soros Fund Management at the founder of Key Square Group, a global macro fund. So this guy here, has been mentioning to us that the stability is somewhat challenging by the trade policies under the Trump administration next year. So for example, right? So the proposal, I don't know if you guys have heard about it, but I've talked about that on my video today, talking about the tariffs that Donald Trump is trying to impose. So the proposed 25% tariffs on Canada and Mexico could not only breach the USMCA trade agreement, but also would be making more inflation pressures by disrupting the supply chains. Okay. And this, of course, will add another layer of complexity to the Fed's decision making, right? And I think that once, one day before that, we had on the 22nd of November, we can see here right down the bottom. Hopefully you guys can see that. Let me get my pen to just circulate that. But right here, 1 day ago, okay, the probability was 52% for a cut and 47% for no cut. So current. Okay. 1 week was 58, 41, and 1 month was 74% and 24. So after we had these President Trump coming in saying, we're going to be most likely doing 25% tariffs on Canada and Mexico, this would be making another layer of complexity on the Fed's decision. And the market implications is, of course, the US dollar remains very, very strong, as we saw this morning. So let me take all of this, then let's come to here. Put it on the 50-minute chart. Sorry, guys, I really don't know, but my throat is really bad. All right. So as we saw here, just today, this morning, 11:30 a.m., 10 a.m. to 11:30, we saw this massive gap on the US dollar index. And this is based on the 25% income tariffs that the Trump will impose on Canada and Mexico. So, the US dollar remains very, very strong by the relative robust economic performance, I think, first of all. But while the dollar index, the DXY, as we can see, is strong, it could enter a phase of consolidation right now at the 107 level. Okay, we can see it right here that it haven't been moved much. Where is my rectangle? It haven't been moved much from this area, right? We've tried to break through above it and coming back, sort of somewhat retested, but continue to go higher. Maybe we could see a consolidation on this area of the 107 to 106, just this 1,000 points. But with some geopolitical dynamics, particularly the administration stance on the trade barriers, on the trade tariffs, this may add some volatility to the market, right? So for us as Forex traders, we should be monitoring key releases such as like the PC inflation and as well as the FOMC minutes is very, very essential for us. So what should we consider from going from now onwards, right? So with the Fed easing cycle progressing very cautious, we can expect some sort of debate around the terminal rate. What should be the best for 2025? What should be the best for 2024? Because if we come back to the CME tool, I've sent the link to everyone. It's the last link on the chat. Come to CME and then go into the dot plot and click in chart right here on the left side, dot plot and then chart. You can see that the majority of voters, the participants of the FOMC, they are expecting for 2024 to be somewhat between 4.5%. Now, if we come to current right now is 4.5 to 4.75. Remember that the rate is always a bend. It's not always a fixed point. It can't be a fixed point. Otherwise, it would be a disaster. Otherwise, it wouldn't be the volatility on the market. Okay, so we need definitely some sort of a bend. All right, it's not a fixed amount. It's not a fixed point. So now current rate is 4.5, 475. If we come to chart that plot, dot plot chart again, why is it not? Oh gosh, let me reload the page. Some bug happening.
Oh, yeah.
Sometimes this can be very, very slow. Yeah, I don't think it's gonna load anymore. Yeah, nothing is working, guys. Sorry. Let me close and open again. I just want to show something and we can move. Hopefully it helps. Feel like it's not gonna do it. But anyways,
Yeah.
so moving ahead. So basically, interesting. Never happened. Let me try again. Okay, there we go. Perfect. So as I was saying, it's somewhat between 4.5 to 4, I would say. All right, 4.5 to 4. So that is showing to me that they will do another cut. All right, so 425 to 4.5. So that shows to me that yes, they are most likely doing a cut in December, in the last meeting of the year, in the 18th of December, pretty much 10 days after my birthday. It's going to be really good. So very cautious, all right? We should expect some debate or whether we should do another 3 cuts on the first quarter of next year. We should do 1 cut on the next quarter. So we should expect some sort of debate coming from the terminal rate. So the latest market pricing is showing to us that 56.2% is expecting a 25 basis point cut from 4.5475 to 425 to 450. That's where we should be expecting the Fed to end the year on December cut. But even with these, the Fed will likely aim for a much more measured approach, focusing on the gradual disinflation rather than the aggressive cuts. Sometimes the market can be expecting something, but the Fed would deliver a completely different thing. And this is because the Fed is, it's an independent party, let's say like that, right? Like they like to call themselves. So with that, just to finish the US dollar, United States navigating the uncertainties, with that, we can see that the US dollar may end the year on a consolidation phase, okay? And if you're smart enough, you know that if we just try to add euro dollar on top of here, well, it's not, there we go, euro dollar on top of the US dollar index, you're going to see that it's the complete opposite. So whatever the US dollar does, US dollar index does, the euro dollar will do the opposite. So if the US dollar is, I'm expecting the US dollar to be dominant to be on a range, most likely we will have euro dollar on a range as well. Okay, I can even do an Alt E here. Sorry, is it Control E? No, it's not Control E. I forgot where it is. It was Alt A. Oh, it's not working. It's opening something else on my computer. But anyways, let me just click here then. We can see that it's completely the same, right? So we can see that the US dollar is on blue and the euro dollar is on pink. And we know that is exactly the same. So most likely we may have some uptick on the euro dollar, somewhere around the areas of, maybe not up, sorry, down. Yeah, down to 105, 106, yeah, 106 area. And for the US dollar, we may look to the coming back to 106 area. Okay, so what I'm looking at the US dollar is basically US dollar coming lower at this point, and then euro dollar coming higher at this point, 106, and then ranging from 106 to 105, 106 to 105. Okay, so that's what I'm expecting for the year end on euro dollar and US dollar index. Now, moving on, we have Eurozone now. Okay, so let's go to economic calendar here. And I want you guys to pay attention. Let me get my pen. This. PMIs. And other PMIs. That was not the only one I had, but yeah, it's the only one I have. That's fine. Okay. So the Eurozone is, is facing some really, really big pressure. Oh, by the way, guys, this is FinLogic's economic calendar. Let me send the link on here on the chat. FinLogic's. Done. I did done. So You guys can click it and go with me as well. So the Eurozone is basically facing a lot of pressure. All right, the PMI data continues to show some sort of resilience, but it's highlighting some contraction, in my opinion, particularly in the service sector. Right, if we look to the service, we saw that the 51.4 previously was expected to be 51.2, came up to be 51.6, pretty much 0.2% higher than the previous. So it's resilient, but it's contracting. All right, it's not expanding on a huge pace. So definitely not good for Europe. And this downturn has led to increasing the speculation about the ECB next steps. Unfortunately, we don't have the rates publicly available. The overnight swap rates like the Fed does, like the CME tool has. So for that, I will be using Prime Market Terminal on. It's a paid subscription, but I bring here to everyone. So basically, what the overnight swap rates is expecting for the next move is a cut, and is a 25 basis point cut. All right. The possibility of a 50 basis points cut in December was somewhat high a few weeks ago, but it has loomed once we saw the PMI numbers. So, but the ECB is balancing the need to support the growth as well as support the growth against the risk of fueling more inflation into the economy. And we saw some recent data on the consumer and business confidence report suggesting that any policy mistake it could worsen the already fragile economy situation, right? That we have the sentiment of the economy. So there's definitely it's a very, very decisive month, the month of December, and this is why I've put it up here. December monetary policy and market movements. That's one of the most fragile moments of the year, because everything is looming towards that part of the year that when we're going to be getting like the whole thing around ECB, FMC, BOG, and etc. So my Eurodollar outlook, if we have a look at the Eurodollar right here on FinLogic's chart team, let me just delete these box. Oh no. Wrong one. Beats. There we go. So if we look to Eurodollar, let me put it. That's a 1 hour. So for you to get access to FinLogic's chart, it's free. All right. We don't charge you anything. Just go Google and type finlogics.com. I will send the link to everyone. And then you come to chart and you can see it right here. It's free. I have my own account. All right. But if you guys want to create an account, you can definitely create an account. Follow us. The trade signals we give, latest ideas, the webinars, and everything. Cool. But for charting, you can just click on chart, and that's where you're going to be heading. All right. You can, for you to be able to do like 4 charts, you need to have an account, but it's free for you to have an account. You just register with your email or whatever it's easier for you. Okay. Now, for you to have access to one chart is easy. You just click it's free. Now, for me, the euro remains under pressure. All right. With a bearish outlook against the US dollar due to weak economic fundamentals and the interest rates differentials between the USA and the Eurozone. So ECB and FOMC rates differential between those two, as well as the weakest economic growth that we're having on Europe, is somewhat making much more pressure than what everyone was expected to be making on Europe. While the short-term recovery, some sort of pullbacks are possible, it's unlikely for them to maintain and given the structural challenges in the Eurozone. If we look to GDPs, PMIs, that I say, it's very, very on a very turn point of the year, especially next month. But pullbacks may be possible, as I was saying, maybe 106, we can have a pullback around here. 106 a pullback as the US dollar will head down towards this area of 106. So most likely we have a up move to 106, but I don't see any huge pullbacks like that. Now I don't see something like this. Sweet say, Luca, I do text you on Telegram account, but it seems you're mind to skip my text. Oh, sorry, Sweets. I literally don't check much my Telegram. I only check the Telegram to send you guys things. Oh yeah, there you go. I have a few questions. I don't know if you're available for that. Yeah, definitely. All right, I've just sent you a message, Sweet. So definitely you can send it over to me, and I will have a look onto it. I got some time. Now, continue. So yes, I don't see euro-dollar coming back on such a huge pullback like these, especially on these structural challenges that we're having on Eurozone, as well as charting wise. We from 112 all the way to 103 something. Yeah, 103. So I've mentioned about 104 being the target from some big banks, some big institutions. So there's definitely plenty of room for pullback, but not that much as well. So it's pretty much everything is aligning with my early analysis that I've done on the euro-dollar strength. That is losing its strength on the euro side and continue to go low higher on the US dollar. So very good. So looking ahead, what should we expect from euro dollar? Right? There you go. So looking ahead, I think the most important thing would be watch for inflation data from Eurozone, as well as the updated ECB policy commentary. If we do have any speeches, it will be very important. We do have a few speeches this week. I've mentioned it already on the week ahead. If you've not watched the week ahead on the YouTube, I definitely recommend you. I'm going to send the link right now. So for those who don't know that are new here, we do have a week ahead every Monday. All right. So every Monday I do a week ahead. So it's called In the Markets. I'm going to send here. Week ahead. I've sent on the chat so you guys can have a look at that. But going forward, watch for inflation data points, watch for ECB commentary speeches. This will be very critical in determining if whether the December's decision paved the way for recovery or if it's going to be paving the way for even a dip in existing challenges on the Eurozone. All right. But euro dollar for me, maybe pullback, small pullback, but not on a huge uptrend. All right. Now, let's talk about the Japan, the stability amid global shifts. All right. So among the G3 economies, Japan stands out as one of the proactive, I would say, proactive fiscal and monetary mix. Right? We saw they announced a $250 billion fiscal stimulus for the economy, combined with the expectation of a 25 basis points hike from the Bank of Japan. And this is pretty much underscoring a unique approach from the Bank of Japan. We don't have BOG overnight swap rates as well, but we do have publicly, but we do have here on the prime market terminal. So if I come to Bank of Japan, we're expecting a hike for the next meeting. The probability is 55%, so only 5%. All right, let's call like that. And the current rate is 0.25%. Sorry. Yeah. The current rate is 0.25%, and the change is expected to be at 0.20%. So a 20 basis point hike. And that will occur one day after the FOMC, and it's going to be on the 19th of December 2024. All right. And we can see that, yes, there are expectations until the 30th of October on 2025 that we may have the rates below 1%, but still at above higher than 0.25% that we're having right now. So they are expected 50 basis points, incremental 50 basis points hike until October of next year, 2025, on the bank from the Bank of Japan, raising the rates to 0.71%. Okay. Now, what makes Japan different? All right. What makes Japan different? Because everyone talks about, Japanese yen, it's really, really strong. Japanese yen is a safe haven, but what makes it different? I think we should be talking about central banks here, okay? Because while we have central banks balancing easing cycles, the Bank of Japan is navigating towards a gradual tightening cycle. And this basically positions the yen more favorable. Because particularly against the euro, all right, when the European weakness amplify the yen's relatively stability. But when we have two central banks, let's say ECB and BOJ, right? ECB, European Central Bank, and BOJ, Bank of Japan. When we have one monetary policy easing and another monetary policy tightening, we have basically investors seeking more reward that we're going to be having on Bank of Japan. And the investors that were with a high reward now will be getting less paid. So this positions the Japanese yen to be a very stable market on the bonds, paying always the same for years and years and years, now to become paying even more for those. So for those who are seeking more stability towards investment, they will run to Japan, right? And then they won't be looking to go for ECB anymore because they know that ECB is reducing the rates. So this makes the Japan very, very different, okay? But there are some challenges remaining, all right? Despite this supportive policy that we have from the Bank of Japan, the global factors such as the strong dollar and the raising US dollar yields, USA yields, will continue to weigh on the yen. So against the US dollar, the yen may face some sort of prolonged consolidation because the market will be looking to assess the interplay between the Bank of Japan domestic policies and as well as other external pressures. But if we go to FinLogic's charting and then look at the US dollar JPY, we saw that sometimes it's strong, sometimes it's weak. And then this is pretty much making the market consolidated at the moment. All right. Yes, we're definitely going up. We've been going up since September, but right now we've not been anywhere. All right. This is pretty much it where we're going. Up, down, most likely up. I do believe on a weak Japanese yen by the end of this year, but we never know. Now, the implications that we could have for this is that the yen trajectory will likely reflect on a very stable to strengthening outlook. So particularly in pairs like the EURUSD JPY, as well as CAD JPY at the moment, because CAD is really, really weak. All right. So if we look at CAD JPY, we can see that this morning we've had, Trump talking about imposed tariffs, and the Canadian dollar is very weak, but still consolidated. This is a 1 hour chart, but still consolidated in some instance, right? But however, I think we should be remaining very cautious of the volatility driving by global risks sentiment shift that can possibly happen on the next 2 to 3 weeks. But yeah, look, we may have some sort of weakening, but as well some sort of strengthening Japanese yen. But there is, definitely opportunities on the market over there. Now, that's pretty much it from me on the Japanese yen. And now let's talk about the emerging markets. Okay, so emerging markets spotlight on Central and Eastern Europe, and then later I want to talk about as well the news that has been happening and been causing the US dollar to be very, very strong in the past couple of hours. So the emerging markets, I don't have much to show, but it's a very, very quick thing, and some sort of tightening to be on geopolitical influences as well. But look, let's shift the focus now to emerging markets. Central bank, the Central and Eastern Europe, the CEE, is on the spotlight. Okay. And Poland's upcoming inflation and GDP data will be very pivotal in assessing the region's economic trajectory. The broader picture is that despite some positive indicators, the strong US dollar and weakening euro continue to exert some pressure on the CEE currencies. And this is pretty much highlighting that the interconnected nature of the emerging markets with the broader GT trends. What should we be looking at is that if Poland's monetary policy stance could signal a broader region trends, this could be strengthening the euro. Now, if they don't do that, then euro will be continue to be weakening and weakening and weakening and weakening. So this is just how the interplay between the emerging markets G3 and the actual decisive markets G10 is playing itself. Now, we should keep an eye as well on the geopolitical risks that may disproportionately affect smaller open economies in that region as well, on the CEE region. All right. I just thought this would be helpful for those who are maybe trading euro as well. It's just another point saying to us that euro may be weakening in the short time. Okay. Now, as I've mentioned, we do have some geopolitical influences, and the Trump trade policies are making itself presented. I would say a wild card. When you're playing a game with a friend, and then you get that wild card out of your pocket, and boom, right? It's the strongest card that you have on the deck. I would say that what Trump just said about the 25% in tariff on imports from Canada and Mexico, it's a very policy direction from Donald Trump, and it's proposed. He basically proposed that tariffs and stance on trade could disrupt the established economic dynamics. So, for example, right, a 25% tariff on imports from Canada and Mexico risks escalate the trade tension and violating the, as I've mentioned before, the USMCA trade policies agreement. An additional 10% tariff on Chinese imports could heighten global supply chain disruption, and this would exacerbate inflationary pressures on the US. So this could definitely influence the central bank's monetary policy strategies, because no one was expecting from that, right? Particularly in how they will balance inflation risk with the growth stability. So, as I've mentioned, this definitely makes the Canadian dollar very weak, right? And why is that? Does anyone know? I do have some reasons, but I would like to know if anyone will know that. Let me just bring USDCAD up until we got some answers. Interesting. All right, we got some. Due to traffic, falling oil prices, tariff hikes. What is the question? So the question is, why did that 25% tariff that Trump said that he will do on Canada and Mexico influence the Canadian dollar to be weak? As we can see, US dollar CAD is hugely going up. There are a few reasons. So basically, the first one is the you're talking about trucks. Okay. So basically, the first one is the economic impact on Canada. So basically, Canada is heavily dependent on the trade with the US dollar, right? With the USA, sorry. So Canada relies on the US market. Basically, USA is the largest trading partner from Canada. And the tariffs make the Canadian goods more expensive in the USA. So potentially we reduce the demand from Canadian exports. And this will be most likely impacted on sectors like the automotive, agriculture, and as well manufacturing, which form a very significant part of the Canada's economy. And this could definitely reduce competitiveness on the US market. The second point is the reducing investors' confidence, right? Once we have the threat of the tariffs introduce some sort of economic and trade uncertainty, which will make investors worry about holding the Canadian dollars. Investors often sell the currency in an anticipation of the economic slowdown. It doesn't make any sense for me to be holding something that I know that the economy won't be doing great in next 3 months. So the Canadian business reliant on the US trade could suffer, and this will reduce the profits and leading to decreased investments in Canadian economy as well. The third topic is the potential economic slowdown. Once we have reduced investors' confidence, most likely that the Canada GDP relies heavily. We all know that the Canada GDPs rely heavily on exports from the USA, and a sharp decline in exports could slow the Canada economic growth, making the Canada dollar less attractive. And the risks, while not explicitly stated, Canada might some sort of retaliate with its own tariffs, and this would escalate trade tensions between USA and Canada and further harming both economies. And now the impact on the monetary policy, just to finalize, a weaker economic outlook might force the Bank of Canada to adopt a more dovish stance and potentially delaying rate hikes or even cutting interest rates. But lower rates, as we all know, make the currency less appealing to investors compared to other currencies, especially when we talk about rates strategy, right? As I was talking about before. And as we all know, once all of this mess happens, fleet is safe haven assets. So basically the tariffs could exacerbate global trade tensions, pushing investors towards safe haven assets like the US dollar, as I've just mentioned, the Japanese yen as well. And this will further weaken the Canadian dollar. Okay. Satish say deficits balance of payments for Canada. Yep, that's correct. That's on the BOP. That's a deficit on the BOP, the balance of payment. That's correct. Okay. Now, to finish everything, I think we have a very busy December, and then we sort of find ourselves on a crossroads. We want to trade something, and then that something is not good, and we want to trade something, and then it's not good. What I would suggest to be looking at December is definitely pay attention on monetary policies. Okay, definitely pay attention on monetary policies. That's going to be really huge. Data points such as CPI, GDP, PMIs for Europe, USA, Canada, Japan. I think those three currencies would be very highlighted. Okay, Euro, Japanese yen, US dollar, and Canadian dollar as well, 4 currencies. So, geopolitical dynamics as well, as we've covered that on last week. But yeah, I think stay informed ahead of everything to happen is the key point for December. So basically, to recap, let me bring here.
Yeah, my name is Otto. I was born
the Fed cautions approach underscores the importance of the data releases, particularly the PC, inflation, and the FOMC minutes. Second topic, we've talked about the Eurozone and the balancing act. The Eurozone economic challenges highlight the need for we have to watch the ECB decisions. The third, Japan's stability amid global shifts is basically, Japan is very unique when it comes to fiscal and monetary positioning, and this will offers a lot of opportunities, but also risks in the global effects. And then the fourth and last but not least, the emerging markets remain very susceptible, I would say, to G3 trends, emphasizing the need for a more nuanced approach. As always, guys, be able to adapt yourself on the market to these sort of dynamics will define your how much opportunities you can find down in a track. Aditya says, hey, Luca, what about NZD outlook? Most likely bullish, okay, especially now with the Japanese yen and the Canadian dollar.
Oh, okay.
Most likely bullish.
Yeah, I understand.
Guys, we've come to an end. Thank you so much. I hope it could help everyone. All right, thanks, sweets. I will have a look on that once I got it some time. And guys, enjoy your week. Take care, and I'll see you tomorrow on the next webinar.